So now that we know support and resistance, we know trends, we're going to look at patterns and really dive into the key ones and go a little bit into some examples. So really a pattern is, it's where there is a similar characteristics in a type of motion that the market has, whether upward or downward trend, and it's the beginning of something. So these are very key at identifying market making opportunities. We're going to go into a good amount of details. For example, you might have heard of cup and handle, or head and shoulders, or flags or pendants. Let's really look at more details about this. Let's go right into it. So there's three real different types of triangles, and triangles are the first big one I want to talk about. There's symmetrical, ascending, and descending. Symmetrical is kind of a neutral one. Ascending is more of a bullish, and then descending is bearish, meaning downward possibly. So here, let's look at an example. This right away we can see is an ascending triangle. So notice that the formation of the triangle is at the top. And here's the result. Boom. A massive pop out. So notice that it clearly breached the top of the triangle and made it close above it, and it strongly broke out. So here's a great example of a descending triangle, which is basically the opposite, reverse. So as we can see, the triangles towards the bottom, and the moves are getting lower and lower, and this is the break point, and the result, boom, a massive sell-off. So this is a symmetrical triangle, which is basically, I almost want to say neutral. It can really go either way. I've seen it go either way. In this case, it goes lower as it breaches outside of the triangle. So you can really play these by waiting for it to close strongly outside the triangle, and you can expect pretty big moves. The size of the triangle itself from low to high is what you can expect. This triangle moved pretty solidly and made a pretty big sell-off as it broke out of the triangle, but it could go either way if you look at many examples. The next pattern is rectangles and channels, which are shown here. Let's look at an example of, so we can see here on this chart that the rectangle is to the left right here, and you have ability to buy at the support at the bottom. So the rectangle makes a horizontal support and a horizontal resistance, and really the best way to play a rectangle is to buy the support and sell the resistance. And a channel is the same thing, but it's just going either down or up. So this would be a bearish channel, and it creates a lot of opportunities to buy at the bottom and sell at the peaks. So let's look at the next one, which is wedges, which are found at the opposite end of a breakout. So like a bearish breakout is in a rising wedge, and a bullish breakout is in a falling wedge. So here are some examples of different wedges, and you could really kind of compare them to the other patterns that we are talking about. So let's look at an example. So for example, let's look at just like a wedge. So a wedge, really the big thing you grasp from it is that the price is narrowing. So this is a ascending wedge, and this is typically going to fall and be bearish. So as we can see on this gold chart, it is going to break down out of the wedge as the price narrows, and boom, drop. So let's look at another wedge, which is the opposite, which is the descending. So as the price narrows, this time the price is narrowing as it's getting lower. The peaks are getting lower and lower and lower. So price is coiling. It's like a spring, and it's going to pop up. So boom, it breaks out of the wedge and it skyrockets higher. You can take profit at the high point of the ascending wedge, which is right there, and that'd be a good area. So the big one also is the head and shoulders, which is very common and really important to know. So let's look at another one, which is head and shoulders. So on the left we have a left shoulder, in the middle we have the head, and the right shoulder. But notice the Shoulders are lower than the head. That's what really gives it the definition. So we're anticipating it to break what's called the neckline, which is like the support down here, which it will break in this example, as we can see, and boom, that yields us a nice profit. So once it breaks the neckline, which is like that support, it anticipates to fall lower. For example, in this type of other big one is called double top. It has a first and a second peak, which both get sold off, and then the neckline. So the real opportunity really is to nab the second peak and to sell that off. So let's look at an example. Here we have the first peak, the second peak, and at the second peak we know that it's a short opportunity that yields us a pretty good risk to reward ratio, and we can make a move to short it and capture, for example here, a pretty nice downside move. So the last big one is the double bottom. As we can see, there's a first and a second bottom, and then there's the neckline, which is the breakout point. So this is really common. Double bottoms can really make you a lot of money. They don't always work, but the majority of the time they are pretty efficient. So the double bottom's pretty simple. It has one bottom here, and then really the second bottom at another point, and then it makes a move up, and then boom, you could start to accumulate even more orders here, and you get a pretty nice move up. It has a few different variations. It's a pretty nice reliability overall, the double bottom, not always, but double bottoms are pretty nice to take advantage of. Well, I hope you've really enjoyed this video and are enjoying this series. I hope it's helpful for you. Please like, subscribe, and comment, and I'm looking forward to seeing you in the next video.